Yep.
So it is Wednesday, July the 8th. It is 9 o'clock, coming to you all, as we always do, from Investing Education Academy. So for everybody, today we're going to be talking about international exposure inside of your portfolios. How do you get it? What is it? What are ADRs? It's a couple questions that have come in, and people really don't understand how to get that international exposure inside of their asset allocation model, i.e. their portfolio. So we're going to talk about it today. Leon, would you like to start us off?
Yeah. So we've gotten questions inside the IE membership here in the Facebook group, and just Brent and I talking to people in our days about international exposure. Everyone knows the U.S. Well, I don't know if everybody knows, but the U.S. is the largest economy in the world. However, China is right behind the U.S. Then you have Europe, you have Africa. So there are a lot of opportunities outside the United States. And some people would even say the United States, not now, but at least before the COVID drop, was a bit overvalued. So a lot of investors were actually looking overseas for cheaper stocks, cheaper markets. The big hedge funds, mutual funds, they know how to do it. They actually have accounts overseas. They have offices overseas, so it's easy for them to actually get that international exposure. Whereas for us, the retail trader, it's pretty hard. One of the ways I've been asked a lot about is how do people ask me how do they buy stocks overseas? What I tell people is you really can't. Us as retail investors, we don't have access to foreign stock exchanges, right? In order to do that, you have to have an account set up over there. You have currency conversion. Then there are fees involved. So, you could if you had kind of those relationships over in China or over in Africa, but it's just a headache, right? It's not realistic for retail investors like us. But one of the ways you can do it, a lot of people don't know about it, are something called ADRs, and that stands for American Depository Receipts. And basically,
real quick. Yeah, so for anybody who's wondering, when he talks about the fact that it's hard for a retail investor, retail meaning the average person, the individual who's just buying stocks, kind of, not necessarily playing the market, but investing just to make sure they have a better future. Normally institutions being big accounts, we're talking 500,000, is small on the institutional side. So these are people making massive trades. Institutional investors are institutions of history, American funds, or certain brokerage houses, Merrill Lynch, they're considered institutional investors. It's not the person who has maybe a joint account with their wife or husband, or the young adult who just has their own, they're trading their own account. So you all can be considered retail investors. Mm-hmm. And yes. Also, for some of the terms we're using, if you go to investingeducationacademy.com, we actually have a breakout of some of these terms, especially when we talk about ADRs, American Depository Receipts, and how they work. I think Leon's about to go through how they work, or I'll go through it, whichever one we end up doing. But these definitions are on our site. And for everybody who's listening, please let your friends know, share this information, because we want to educate as many people as possible. Because although it was strange before to, have foreign exposure, you would have to go to a mutual fund. We could still get it. It wasn't impossible. So we want to be very clear that it was definitely possible. It just wasn't the norm. And then when I think the credit crisis of 2008 hit, people who had international exposure were getting murdered. Your portfolios were just losing money and nobody knew why. And everybody just defaulted to the average person wasn't a sophisticated investor, and that's why they lost in the international market. And that's not necessarily true. So we're going to talk about that today.
Yes, Brent said, yeah. So retail investor, just think the average Joe, you and me, us, people on this live, Brent and I, the average person who, buys and sells stocks on their own. That's the term. When people say retail investor, that's what it means, just the average person. But like I said, the easiest way for us to get exposure to international markets are something called ADRs, and that stands for American Depository Receipt. And all that is it trades just like a stock. So it has a ticker symbol or a stock symbol. You just put that in your platform, pull it up, and you would buy and sell it like a stock. But just give a little background on what actually they are. So what it is so to go public in the United States, it costs tens of millions of dollars, right? It's not a cheap process at all. And foreign companies overseas, a lot of times, if this isn't a primary market for them, they're not, they don't necessarily see the benefit of spending tens of millions of dollars to go public in the United States, but they still want exposure to the United States investor, right? So what they'll do is they'll partner with a bank here in the United States. That bank will then buy up a certain number of shares of that foreign company. Then with that comes a whole thing about currency exchange and the like. We'll not get into that. But that bank will then buy up some of those shares. And then when that happens, that bank then basically becomes like the representative of that company in the United States. And that bank helps to issue these ADRs on the stock exchanges here in the United States. So for instance, an example is Toyota, right? Toyota, ticker symbol TM. That's an ADR that you can buy just like a stock. But that gives you exposure to the company Toyota back in, I believe it's in Japan. And without that ADR, we wouldn't be able to buy or participate in anything that Toyota does. So that's just an example of how ADRs work and what ADRs are. And Brent, if you could throw up that slide one. So this is just this kind of gives you a definition or a breakdown of what ADRs are. I kind of just explained it, but like I said, one of the big things is that for foreign companies is that launching an ADR in the United States is a lot cheaper than launching an IPO. And IPOs are done a lot of times for a lot of reasons, business reasons, dealing with vendors, even some political reasons why foreign companies will launch IPOs. But companies that aren't looking for all that like digging into minutia like that, are just looking to kind of list their shares and get exposure to the US market, they'll do ADRs. And it's great for us because it gives us exposure to foreign companies.
Yep.
So you just kind of
real quick for anybody who's listening to the podcast, we're looking at a slide right now of American Depository Receipts definition, and it's ADR for short. So just to read it to you so you know what we're looking at. ADRs are a way for American investors to invest in foreign overseas companies without having to worry about expensive transactions costs or international currency conversions. They are bought and sold just like regular stocks. ADRs are a convenient, inexpensive way for American investors to gain exposure to international markets. And below on the same chart, we have 4 examples of more than 400 ADRs that we found, some of which are Alibaba, Banco, Santander, Brazil, Toyota, and China Life Insurance. So for those of you all who are just listening, that is what the slide we're looking at right now.
Yeah, so we found over 400, I believe it was like 400, either 407 or 410 different ADRs that are listed on U.S. exchanges that we can participate in and buy. I mean, and you think about it, I think they're like 200 and some odd countries in the United States, I believe. In the world, I believe. So some of these are overlapping, but I mean, these 400 we found give you basically exposure to almost every country on the planet. And some of them are more liquid, and some of them trade, have more volatility than others, and some of them are really quiet. But it gives you exposure. I mean, and Europe, Africa, Asia, Switzerland, you name it, you can get exposure to these foreign lands via these hundreds of ADRs that we found.
Quickly, ADRs for those of you all who maybe if you're probably, I say 45 to 70, the thought of an ADR was pretty scary because there was a time where there was an illiquidity risk that related to ADRs as you bought and tried to sell them. Even with market makers, sometimes they weren't easy to sell. So that pretty much has gone away as we move more towards really a true global economy. And ADRs are really an amazing way to get foreign exposure inside of your brokerage accounts without having a deep understanding of international markets.
Mm-hmm. Yep. And like looking at this chart, so you see Alibaba is the first one we have listed. And a lot of people know about Alibaba, but a lot of people probably didn't know that it was an ADR. So that allows investors in the United States to get exposure to that China market and to Alibaba, based in China. So so chart here we have.
For anybody looking at this chart and just a piece on Alibaba, I had a question about this. It was off topic, so I'm just gonna make it real quick. Alibaba, many people had kind of come under the impression that it was the Asian version of Amazon. That is actually not correct. Alibaba is a company that kind of underwrites Amazon, if you will. A lot of the products that you see being sold on Amazon are directly sourced from Alibaba, and Alibaba has boots on the ground in China to source directly from the manufacturers. So in a lot of the cases when you see fulfilled by Amazon or these Amazon resellers, Amazon's part of their whole existence is predicated to the fact that people source from Alibaba to sell on Amazon. And a lot of people just didn't understand the relationship. So I just wanted to point that out.
Yeah, it's true. I mean, and to that point, you know, if I don't know if a lot of you heard of Amazon sellers or Amazon resellers or FBA, all those 99, well, I'm not saying it, a lot of those people,
a lot, like, whoa,
a lot of those Amazon, quote unquote, Amazon sellers are buying their products off of Alibaba. And as Brent said, and they're doing that because Alibaba has, like I said, boots on the ground. They have a lot of offices in China. And they're like a marketplace in China where you can buy goods at, I mean, I've seen stuff in there, like stuff here in the United States, you know, you go to Walmart and pay $4, right, for a product. You can buy that product, you can buy like 10 or 20 of that product for like 2 cents on Alibaba. Like, it's crazy.
Yeah, but so, just so they know, if you buy it on Alibaba, normally it's treated similar to bulk selling. So right. You're kind of restricted to buying 200 units or more. So right. Don't think that it's unit for unit. It's not. So just be aware of that. People are right. Like, oh, I'm running Alibaba right now.
Yeah, no, yeah. It's definitely bulk. So yeah, so you'll buy one at Amazon for $4. You can buy like 20 on Alibaba for a price of like 2 cents each. So it's kind of like a bulk seller, but I mean it's Alibaba runs China, and in some ways they kind of run the world, because as Brent said, a lot of the world e-commerce happens on Amazon, and a lot of those products are sourced via Alibaba. Yep. So back on our topic. So Alibaba is an example of an ADR. So in Toyota, all of us have heard of Toyota. Well, most of us heard of Toyota. You can buy that. The ticker symbol is TM, and that then in turn gives you exposure to Toyota here as well as Toyota in Japan. Now, one of the ones you may not have heard of is Banco Santander in Brazil. Right, this is a pretty large bank in Brazil that you can get exposure to. You can buy that ADR and have exposure to the Brazilian banking market, as well as the last one, which is really big, which is China Life, which we all know China. Well, most of us know China is the biggest, most populous, either that or India, one of the biggest, most populous countries in the world. And life insurance there is I'm sure a huge market. So China Life Insurance is another one that that you can buy via these ADRs.
And China Life has recently, if anybody follows the market, has started to get a lot of attention for the growth that has been able to have even amongst COVID. So when they took a dip, it really wasn't that deep of a dip when, around that March. And for China, it was last year. It was like September 2019. China Life is held strong and it's growing. It's actually been rated a buy by a number of Wall Street analysts. And for Banco Santander in Brazil, you got to think about the Brazilian economy right now it's considered a growth marketplace. Brazil is considered an emerging market. And so to get into the banking system, which many should know, banks run the world, and how banks allow for businesses to receive funding to operate. Banks have a lot of political weight. Banks move money. And so when you think about being able to get into a foreign institution, a foreign banking institution, that's kind of cool that you can do it without having to go through, as Leon said, a lot of complication, because you're doing it through ADR. So we're not endorsing any of these companies. We're just giving you all information. But we are trying to say, it's something to think about when you're trying to diversify your portfolio and you're trying to go beyond, domestic stocks or US-based stocks.
Yep. So yeah, those are 4 examples out of the 400 that we found, and we're going to publish the full list of the ADRs on the membership platform, IEA membership platform at IEAmembers.com. So members there will be able to see the full list of 400.
And for anybody who's thinking, well, what is that? We haven't seen it before. The IEA membership is live right now. So we're starting to incorporate it into where we, post our information and where we do our deep dives. But for everybody who's watching, we can still go to the Investing Education Academy Facebook group and further the conversation. However, the listings of the information will be inside the IEA members platform, and anybody's welcome to get a membership by just putting that URL into the URL and visiting us and joining.
Yep. So another way to do it is company specific ETFs. So ETFs stands for exchange traded fund. And basically what it is, it's basically just a fund that focuses on a specific country, right? So if you want to invest in, as you see at the bottom there, you can invest in China via the China large cap ETF, ticker symbol FXI. You can do Russia via the symbol RSX. We have Switzerland EWL and Africa EZA. Now we found 22 country specific ETFs that again we'll list on the membership platform after this. But these are four of kind of the bigger ones that we found that have pretty big economies. And again, as Brent said, if you want to kind of diversify your portfolio away from just American stocks, this is a good way to do it. Another point I want to make is that buying ADRs, which is great, another way to diversify. But one thing that does is that gives you single stock risk, right? So say you bought Alibaba, right? And let's say Alibaba, had a bad quarter, had a bad year, whatever, and the stock drops, right? If you only own that one stock, you're going to take that hit in that stock. Whereas, and Alibaba's based out of China. Whereas had you bought FXI, the China large cap ETF, if Alibaba, because this ETF owns, I want to say, I'm not sure how many it owns, but it owns multiple numbers of different stocks. It's not just one stock. So had Alibaba taken the hit, the other companies that are inside this ETF would help balance it out, right? So buying a country specific ETF will limit your risk versus buying a single stock ADR in a specific country. So I just want to make that point that you lessen your risk by buying an ETF, country ETF, versus buying just a specific ADR for a company in a different country.
And for anybody who's thinking like about this ETF, we're talking about a country specific ETF right now. And the slide we're looking at for those of you all who are listening to our podcast it's defining a country specific ETF that gives American investors exposure to a large portion of a country's economy versus just exposure to a single foreign company, like when buying an ADR, which is the example Leon gave. This is the same concept as buying an S&P 500 index fund, which gives investors exposure to a large portion of the US economy versus just buying a single company stock, which is the reference of single stock risk. Also with ETFs, there's not on the slide is the fact that an electronically transferred fund is like an evolution of a mutual fund, right? And originally mutual funds were the big thing to diversify. If you wanted to diversify, by default, most people would look at a mutual fund which collected institutional money, which was really truly a whole lot of retail investors or regular Joe investors' money pooled into one big pot, and it became institutional money. ETFs took that concept of diversification inside of an investment and merged the worlds between mutual funds and individual stocks. So mutual funds only trade at the close of business on every trading day. So you can't trade them after hours. They don't trade liquid throughout the day. At the end of the day, it's called the close of business price. And that's when you were able to determine how much you pay for your mutual fund or how much you sold your mutual fund for. So if you put in a sell order at 10 a.m., it could not sell until the market closed at 4. And so now with ETFs, they trade real time. So if you're an investor, you're thinking about, again, liquidity, will I have liquidity if I get an ETF? Yes. You will have liquidity the same way you would as if it were a stock. And again, even with that, it used to be trade plus 3 was the time it took a stock to settle or ETF. But with everything happening electronically, I mean, you have almost instantaneous access to buy or sell an ETF.
Yep. And just for a definition of liquidity, all that really means is just the ability to get in and out of the stock efficiently and quickly without your order being held up. You want to sell it now, it sells now. You want to buy it now, it buys now. There's no issue with the trade price. So liquidity just gets you in and out really quickly. So country specific ETFs is another way, a really great way to get exposure to foreign lands. One thing I actually personally, this is me personally, I prefer country specific. Why I prefer it? I would have a larger portion of my specific portfolio in country specific ETFs, just because again, these are other countries that I don't know anything about, right? I don't know what's going on in Switzerland. I don't know anything about Switzerland's economy, nor do I know anything about Russia's economy. but now there are ADRs that we can buy for specific companies in those countries. But I'm not up on those countries like I am here in the US and the individual stocks. So for me, to lessen my risk, I would put more of my portfolio, but more of my money into a country-specific ETF versus a particular stock in a foreign country. And that's just me, again, because I know the ETF will lessen my risk just because I don't have that single stock risk. My money is spread across, maybe tens or maybe hundreds of companies.
Yeah, I agree.
Cool. So this is one way, or actually two ways, to diversify your portfolio and to give you international exposure. And like I said, they're very simple. All you do is take those ticker symbols and just put them into your platform, and you buy them just like a stock. There's no difference.
And again, if you all wanted to go to investingeducationacademy.com, we have the definitions of both exchange traded funds and American depository receipts, in addition to quick definitions of stocks, mutual funds, bonds, CDs or certificates of deposit, options, short selling, and commodity. These are just a couple of the terms that Leon and I realized people are familiar with, but they don't always know. So we went in and we gave a quick glance to give you the definition so you have a working knowledge of what it is, so you can go do more research and actually become familiar with it. And for those of you all who are members of the IEA platform, these are the times where we're actually those are places where we're going deeper. So anybody who is now a member, thank you so much for becoming a member. And, without you all really believing in this, we wouldn't exist. So the support and belief you showed in us by actually writing the check, or, entering the credit card information and becoming a member really helped fuel Leon and I's desire to pour even more in, because now we feel like we're responsible. And with that being said, over the next 2 weeks, you all will be seeing much more activity inside of the membership platform, IEAmembers.com. And to that, this Saturday, Leon and I will be doing our first webinar where we will be live with our community, and we will be answering questions about the investments, the market, live. And it's only available to IEA members. And so if you are, thinking about it, you've been curious about it, now's a great time to make the purchase. And if you have questions, you still can feel free to ask us questions inside the Investing Education Academy Facebook group. But yes, this Saturday we will be taking the stage with 6 p.m. Leon?
Yeah, 6 p.m. Yep, on Saturday.
6 p.m. Saturday, we will be putting out notices, but we just wanted to let you all know because we're kind of excited about it. And there's a lot more of the tribes being built. We're building more tribes right now. You all insight and some of the comments we received, we've put it into place, and we've had our meeting. And over the next 2 weeks, you're going to see a lot of changes inside of the platform. And we're super excited to have all of you all. And for all the listeners and supporters, thank you so much. We truly appreciate you all.
Yeah, the thing Saturdays, we call it the Saturday hot seat. So this Saturday, Brent and I are in the hot seat. And in each was the first Saturday of each, what do we pick? First Saturday or the last Saturday?
First Saturday, yes.
Yeah, the first Saturday of every month, we're going to have Saturday hot seat, where we're going to have, first it's going to be Brent and I initially. We're going to have different guests to come in and sit in the hot seat and have our members be able to ask questions. And sometimes some of our members will be in the hot seat as well. So it's going to be fun.
Yep. And when you get in the hot seat, we're talking about the investments. Like, what made us buy them? What do we think? How long are we going to hold them? We're just having a very candid conversation about our portfolios, because number one, it's a mindset when you get into stocks. Like, I'm in it for the long haul, or I'm in it for the short term, or, I'm trying to get a house. I'm trying to pay for college. I'm trying to, whatever it is, you should know your reason for being in the market. And so with that being said, Leon and I are having our, those who want to be on the hot seat, of course, we're not forcing anybody. Those who want to be in the hot seat can be in the hot seat. But then also, this is a great opportunity for you all, our members, to ask other members questions and just hear their take on it. Because sometimes when it comes to investing, we feel like we're on this island, or we're the only person that thinks this way about investing, or we're the only person that knows this much, or we're the only person that knows this little. And through these hot seat sessions, I think a lot of those myths are going to be debunked. And so,
yep. And I mean, and Brent and I, we don't know everything. Like,
Yeah.
people ask us stuff all the time. We're like, yo, we are not geniuses. Like, I mean, we've been doing this for quite a few years, but we learn every day. So, we're looking forward to answers that members are going to give in the hot seat as well. So it's going to be us at times. It's going to be people we bring in at times from the outside, experts, and then sometimes it's going to be members. So it's, like I said, it's going to be fun.
Yep. So with that being said, anything, Leon, that we missed?
No, I think that was it.
All right. You still have an opportunity to join IEA members. It's open membership. But we look forward to seeing who shows up and who's ready to take this ride and journey with us. Have a great day, and thank you for listening.
Whoa. Forgot our picks.
Yes. Oh. You are, yeah, we owe you all 2 stock picks. I'm glad
Beverly ain't gonna let us go without our picks, man. Come on.
Yeah, I'm surprised my phone didn't buzz.
Yeah, right.
Okay, Leon, you say yours, and while you're doing that, I'm gonna check to see if we had any questions.
Okay, so my pick this week is one that that's not my usual, but I heard some news recently that I really liked. So this week I picked Walmart, ticker symbol WMT, I believe. WMT, Walmart. And I would imagine most of us know Walmart. Walmart's not a stellar growth company. Their 3-year average sales is 4% a year, and the 3-year average profits is 3%. But you have to remember though, Walmart does I think their revenues are up to over 200 billion a year. So when you're growing at 3 and 4% of that huge number, it sounds like a small percentage, but it's still massive amount of money because of the size of their revenue and their sales. So the main reason I chose Walmart this week was either yesterday or 2 days ago. I heard they're coming out with an Amazon Prime competitor, and they're going to call it Walmart Plus. And on that news, the stock jumped 8%, 7 or 8% either yesterday or the day before, and it came down some today. But based on that alone is really my reason for buying Walmart right now. I like where the price is. Like I said, they're a steady grower. They do their revenues and sales are pretty consistent year after year after year. So you really can't go wrong with something like Walmart. Like I said, it's not a big growth. I'm not looking at this as the one that's gonna make me $1 million. But I know it's going to be a steady grower. The stock will continue to appreciate in the future. It's benefiting from a lot of this COVID stuff that's going on now. I know they'll benefit even more once they implement their Amazon Prime like service, which is going to be called Walmart Plus. So Walmart is my pick this week.
All right, and Walmart again is ticker symbol WMT. Again, it's WMT is Walmart's ticker symbol. Last trading at 124.44. So this week, some of y'all may do one of those really, Brent, might get the side eye. So NVIDIA is my pick, and let me share my NVIDIA right now is, I think, positioned very well in the marketplace from a standpoint of doing their chip processing, but their chip processing unit is for gaming systems. Also, they have a very strong hold in the mobile car division. So their chips are going into gaming system and cars. Now we're talking about, number one, we haven't even begun to scratch the surface of what virtual reality video gaming is going to be. And for automated cars, self-driving cars, we aren't close to either one of these places. So I think NVIDIA is going to be very well placed because they have the gaming side and the automobile side, or the automotive side. So I like them for that reason. Now, I am an old school guy when it comes to stocks. So this is my little chart. So for you all who are listening, I'm showing everybody, I had a book. And when I got this book, I rated NVIDIA an 8.5 out of 10 because they had strong growth. I like the fact that they work with gaming and mobile computing. At the time, they were trading at $249 a share. This wasn't even 60 days ago.
It was in March.
$249 a share, and they are now trading at $408 a share. So right now, they are an American-based company too, which I think is going to give them a leg up in regards to being awarded contracts. But even being an American-based company, the development of the chips can happen offshore for a cheaper price point. They have a great management system in place. I believe in their president. And if we look at NVIDIA, they went up 3.49% today. I think we're going to see some pullback. So I'm telling everybody, I think there'll be pullback in that price. However, long term, as Leon and I discussed right before we went live, that's what we're talking to you all about, is the long-term effects of these stocks, and the buy hold strategy is one that is the overarching strategy for IEA, although we still believe in, options trading or shorting, or, those individuals who choose to do swing trading. If that's your strategy, we're not knocking it. We're just saying it's not the one we're focused on. So understand, when Leon picked Walmart and I'm picking NVIDIA today, it's for the long haul. And so the ticker symbol for NVIDIA is NVDA. It is trading on the NASDAQ, and it is trading at $408.64 a share.
And the stock has doubled in 4 months. It was at 200. Yeah. It was at $100 in March. And what's funny, well, not funny, but what's interesting is that, back then, someone may have said, well, it's $200 stock. That's pretty expensive. It doesn't look expensive now. It's now double the price what it was. So it is what Brent always says. Like, people say, well, why some people say, why y'all pick some stocks that are expensive? Expensive, the perception of expensive is relative. It may have looked expensive now relative to whatever you were looking at the time, but looking at it now, NVIDIA looks cheap. I mean, it was half the price 4 months ago. So, and 4 months from now, NVIDIA could be at $1,000, or it could be back at $200. We just don't know. But never just look at price alone as expensive or cheap. There are a lot of other factors that go into, like Brent said, management, product cycles, their market share, things like that. So, being that it's a $400 stock really means nothing to Brent and I. That's just a number. We look at the holistic view of a stock.
Yeah, and for those of you all who are thinking, well, we hear you, Leon. It's not expensive the way you all say, but 400 days is a check I can't write right now. That's why many of these platforms offer fractional shares. Mm-hmm. So fractional shares is the new stock split. And, back when companies were doing stock splits all over the place, you got to think about, institutional funds and some of these investors that we talked about earlier, being the big dollar players. They don't want companies to split, because normally they're paying commissions per share. So they're still paying those commissions. So they actually don't want to see a 10-for-1 stock split. They don't want to see a 4-for-1 stock split. They just want the stock to continue growing and staying consolidated, because it's less on the commission side for them. So, you have these companies, and it's like, oh, well, how do I get in? You can always get fractional shares through some of the brokerage platforms, many of which are free at this point. Not free to buy the stock, but it's free to open an account to then put your own money in so you can buy the stock. So there are ways to get into some of these companies if you all feel like, well, it's too much for me right now. Fractional shares are a great way to go.
Yeah, if all you have is $200, you can buy half of a share of NVIDIA, and you're in the stock. You can benefit from the upside as it moves. You have half a share, but before fractional shares, you couldn't participate at all. Now even if you have $100, you can just buy $100 worth of a share, and you're in the stock. At least you're in the game now. Whereas before you couldn't do anything at all. And
don't forget, no matter what level you get in, the percentage move is still the percentage move. Mm-hmm. So it doesn't change if you're the percentage move. It's just the percent is smaller because your dollar amount. The percent is the same, but it affects you lesser because your dollar amount is smaller.
Right.
But you're still getting the same percentage move as everybody else if you buy fractionally. So just don't ever think that it's a lesser way of investing. It is not. It is a strategy, and it works.
Right. And like I said, it gets you in the game.
Yeah. So that's it for me. You got anything else, Lee?
No, that's it for me. So just like I said, this live was about getting foreign exposure in the market. We covered ADRs, American depository receipts, and we covered country-specific ETFs. So if you're interested in either of those and you missed any of this, just rewind this video or the podcast and go back and listen.
Yep. And we recently want to let everybody know we were featured in Market Watch, which is pretty awesome considering we're still getting started. And a lot of the success we've been seeing is because of you all. Our press release went out in over 100 different media outlets, but you know, we're still growing. So
It was cool.
Yeah, but it was cool to see. It was real cool to see. So, you know, again, if you want to visit us, go to IEAmembers.com. We are live now. We are having conversations. Members are meeting each other, and it's going to be a really great platform to be, or community to be a part of as we grow the platform.
Yep.
That's it for today. We will see you all next Wednesday at 9 o'clock. And for those of you all who are IEA members right now, we will see you all this Saturday, 6 p.m., where Leon and I will be answering questions for all of you all. Have a great day, and thank you for watching with us.